All right, Dr. Jonny, how we doing today?
Oh, I'm good, my friend. I'm happy to be here on your channel and on your platform.
Awesome, good stuff. Yeah, I'm underdressed for the occasion. I'm here in Nashville, Tennessee, actually taking a little time off with the family. I said, you know what, we just closed on this big deal, worked our butts off, put a lot of capital together, executed well. You know, when you have wins in business, you want to take a little time off. You want to reward yourself, recharge those batteries. Because if you don't reward yourself when you have wins and you work hard and you accomplish something great, then you don't have as much mojo to get there next time, as much stamina. So I'm recharging here in Nashville. I had one webinar this week. I said, I could do it from our hotel here in Nashville. So here we are today. So you are the better dressed man of the two today, my friend.
Maybe today, just today.
Just today. Although I don't rock a tie anymore. I haven't worn a tie in. I think the last time I was at a wedding was the last time I wore a tie, So.
Yeah, you just got, and when you said at your wedding?
At a friend's wedding, I believe.
Yeah. Okay, good.
Yeah, I got married like 3 years ago now. All right. So awesome, Jonny. Thanks for coming on here. We're also going to repurpose this as a podcast coming forward. For those of us who don't know, my name is Aaron Fragnito. I'm co-owner of People's Capital Group, and I help people invest in real estate here in New Jersey. So we are specifically focused on New Jersey apartment buildings. And for the last decade, we've been helping people passively invest in New Jersey apartment buildings here. So we are a vertically integrated real estate investment company with an in-house property management company. And we're very locally focused. Now, Jonny here helps people invest all throughout the nation. So he has a different business model. There's no right or wrong way to invest in real estate. The important thing is that you're looking into what you want to invest in, doing your research, but also investing wisely, but taking action. Now, taking action is the most important thing. And Jonny, will open up to you in a second for you to do an introduction as well. But I just want to say, with everything going on these days, the closing of banks, the market turmoil, we're going to break that out tonight. We're going to talk about that and try to figure out what's going on and how we can protect our wealth, but also build wealth in this time. Don't just put your head in the sand and hold for shelter. That it's important to protect our wealth, but also let's thrive. So that's my goal tonight. How are we doing over there, Jonny?
Well, I'm doing great. Thank you so much for having me here, as usual. I agree with you. I mean, I think we're in for a very unique investing environment. And I think today what we're talking about is very important going into it. Like I said, I'm Dr. Jonny Walker, or Jonathan Withananchi. I'm an endodontist by trade. I've been an avid real estate investor since I graduated from dental school. I've started an investment firm that, as Aaron mentioned, we are experts at navigating the world of private offerings, and we help doctors, especially doctors. We have mostly dentists is within our network, but everybody really is. We help people achieve financial freedom through passive investment in real estate. So we're very partial to multifamily real estate. We love risk mitigated cash flowing assets, and we like to partner with excellent operators in growth markets across the country, very much like People's Capital Group.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. Thank you, Jonny. Awesome. Yeah, I think, Jonny, we met when 2017 or so, 2018, sometime around then.
Around that time, yep.
Yep. I believe I remember driving you through Paterson, New Jersey, and showing you the properties we were going to buy. And so I remember one of them was in a bit of a rough neighborhood. Remember that?
We gotta go where where people don't want to go yet, right? Before they know where they want it.
What's funny about that deal is, me and you were standing there in the street corner thinking, okay, the area's kind of gentrifying. It's not quite there yet. It could work. It's near downtown area, near a high school. That deal was one of our best deals we've ever done. I think we made 24% annualized returns for our investors. We got to refinance in a 2-year period. Yeah. Nice. So just knocked it out of the park. And so really a great deal for our investors there. And, we did well in the execution and no doubt about it, but the market also was the wind on our sails. I'll be realist enough to say that. And so we bought it in 2019, we refinanced in 2022, a good market, good time. If we look back at our crystal ball, I'm like, yeah, let's buy a lot more real estate before the pandemic, so just real estate took off. And so the market was strong. We've done well with our investments. There was a win in our sale. We also executed well, but at the same time, a great market always helps, right? It lifts all, raising tide lifts all boats. So now what do we see? So we're going from a really awesome market where we've all done well as real estate investors. If you had, a little bit of knowledge, a little bit of workmanship there, you could do very well in the last few years in real estate, but it's looking like it's going to get a little bit harder now. So that's what we're going to be talking about tonight, is kind of what's happened to the real estate market, what's happened to the market in general. Now, Jonny and I, we're not economists, we are real estate investors. Jonny's an orthodontist. I'm a real estate investor. I actually started as a realtor over 10 years ago, and developed my real estate investment fund from 2013 on. But really always been in the transaction part of the business, kind of the financial structure into the business, trying to project out 15 years where the market will go, projecting inflation, projecting rent growth, property growth, where cap rates are going to be in 15 years. And the truth is, none of us really know. What Jonny and I do in our business is we project and we target things in the future, and we use the data we have to make an educated assumption in the future. We have to, right, Jonny?
Yep, absolutely. I mean, what you're talking about, like, projecting forward and all of that. I mean, that's we do it as good as the best that's possible with the data that's current. I mean, obviously, we don't see things happening like COVID and other black swan events, or the Fed's printing 40% of all US dollars ever printed in an 18-month period. We don't foresee those type of things happening. And what happens is it's created all kinds of crazy turmoil. I mean, after the shutdown, I think really the printing press called the Federal Reserve, I mean, we printed $7 trillion, entered that into the economy. And as a result, fueled by cheap debt, right? Cap rate, interest rates were all-time lows. Cap rates came all the way down. The market was flush with capital. So everything went up. Prices, everything went up. So from like, say, 2012 to 2022, it's been a bull run. I mean, if you invested in stock market, it's been going up. If you invested in cryptocurrency, it's been going up. If you invested in single family homes, it's been going up. If you invested in real estate, multifamily, if you invested in NFTs, digital artwork, metaverse, Michael Jordan rookie cards, no matter what, it went up, right? And I think people got spoiled. Investors got spoiled by this bull run. I think where we're headed for is very different from what we're seeing. And the concept of capital preservation becomes very important. I mean, people kind of threw that to the side because everything just went up. But capital preservation is the number one rule of investing, right? Don't lose money. The number two rule is make money. But never forget rule number one, which is don't lose money. And now it's more important than ever what we put our money into, because we have major headwinds, right? We have inflation that's still running rampant. We have interest rates that's rising to try to curb inflation. We have a country that's in a recession, potentially deepening.
Right.
And we have unstable geopolitical environment. We have this war in Russia. It's a Cold War now, right? So we're already supplying billions of dollars of arms to Ukraine. We have China saber-rattling Taiwan Strait, right? So now we have Americans government, we got to ramp up our military. Billions and billions of dollars of contracts are going to Lockheed Martin to build the war machine, to fund the war machine. Where does the money for that war machine come from? It doesn't come from raising taxes. It comes from printing more money. Right. So when you're printing money, despite inflation, we're headed for I think, potentially very turbulent times. And guys like Ray Dalio, who is a thought leader and has been, runs the largest hedge fund in the world, Bridgewater Capital. He said we could be headed for a time between 1910 and 1945 where we saw asset values capitulate. Wow. Massive wealth was lost.
That's pretty negative.
It is negative. Is it overly pessimistic? Maybe. Is this a potential for reality? I think potentially also. And I think that we should be cognizant of that when we make our investment decisions.
Right.
I mean, what do you think? I mean, obviously you think that that's a pessimistic overview. I mean, what's your take on where are we headed? Where are we headed, and how should our investment thesis change?
It is so hard to say, Johnny. It really is. I mean, if you asked me 6 months ago, I would have been a little more pessimistic. And then if you asked me a month ago, I would have been more optimistic. And then, if you asked me when I'm reading the headlines of these bank closures, I'm pessimistic. It's really hard to say. But I also know that right now we are in just a time where media is just crazy, right? There's always a new news cycle, literally every 24 hours, right? Our news cycle used to be every 7 days, right? There was a time it was 30 days. So now it's every 24 hours. So, what gets clicks is what the media is often putting out. So a lot of these, horror stories get clicks. I remember when the pandemic first happened, all you could read about is how this is the end of the economy, head for the hills. It's never going to come back. Sell your real estate. I remember I was talking to an appraiser in 2018. He said, it's been growing too fast. The market's going to collapse. Sell your real estate now. I remember in 2016, I was talking to a broker. He said, sell your real estate. It's been too good. The market's had a good run. It's about to collapse. In 2020, another appraiser saying, forget it. The market's about to collapse. Completely underappraised my real estate as well, which I didn't appreciate very much at all. And so, I get it. There are a lot of headwinds right now, but I want to also recognize in 2008, we had a real estate collapse, right? A big, the Great Recession, there's a name for it, right? Now, what we saw back then was a lot different than what we're seeing right now. We do have very, very strong employment numbers, right? Unemployment is very low. And I know there's different ways to gauge that and da-da-da. But for the most part, you can't go. I just took a road trip down to Nashville. Every single fast food restaurant has a help wanted sign. Every single, rural restaurant has a help wanted sign. So, there's still a labor shortage, and sure, they might not be great jobs out there, but there are still some good jobs. My wife's looking for a higher level job. There are opportunities out there that we see in the marketplace. But also at the same time, those lower level jobs are getting paid more and more and more. But so unemployment seems to be pretty strong right now. We also don't see as much as that risky trading of, basically crap loans that were overvalued and sold for overinflated prices. That has been cut down on more. Derivatives type of trading that's been limited a little bit, where they take the Class C loans and repackage them as Class A loans and then sell it for a premium. So there's a lot of things that they did crack down on, but at the same time, some of those regulations have been released a little bit as the Great Recession has gotten further and further in the rearview mirror. So I don't want to be one of those guys that sits here and a year from now I got egg on my face as I'm like, oh, it's all good. I don't think it's all good. I think we're in for a bit of a correction. But real estate, you got to look at it. It's gone up 20% in the last, about 2.5 years or so, especially in the market where now. And the other thing about real estate is when I say that, that's such an incorrect statement. I shouldn't even say that, right? 20% where? Nationwide, in New Jersey, in Morristown, or in Plainfield. Real estate is so localized, so we focus on this North Jersey market. It's very, very localized. We have a huge amount of pressure for housing here. There's not enough housing. It's hard to build new housing. It takes years to get it accomplished and approved. There's so many people that need to work here and live here and are well educated. There's lots of jobs and opportunity. So there's just not enough housing. There's so many people that want to live here. So that natural supply and demand issue, I feel, is going to keep real estate values in this North Jersey market decent. Probably not growing over the next few years, but that's okay. I don't need much more growth right now. Let's hit the brakes. Let me buy some deals for decent prices. I'll renovate the real estate I have now. I'll increase the rent on it by doing that. I'll force the revenue up on the building by renovating the units physically. And by the time the market cycles back around, I'll renovate those units. I'll have repositioned the buildings. I'll be ready for refinances. So I'll be ready for rent to start growing again. So I do think, being in a high demand market in apartment buildings that are professionally managed is a place you can head for shelter in this market. And that's just one of them, though. But maybe I'm a little more optimistic than you, it sounds like.
Well, listen, I didn't disagree with anything that you said there, Aaron. I mean, and just because And just because I don't even know if I would say pessimistic, but I'm just saying, I was kind of just stating some of the facts that are happening, like, with the war and potential worsening and bipartisan. But having said all that, we still need to know where to invest our money. Now you didn't ask me, okay, now how would your thesis change? Because guess what? If I had a whole bunch of money and I'm in an environment where I'm pessimistic and inflation is running rampant, that's not pessimism. It's true. Inflation is still high. It still remains sticky, despite we raised interest rates at historic levels. We've never seen interest rates rise this fast in such a short period of time, ever.
Right.
And that happened, and it barely flipped inflation. Inflation's maybe slowed down, but it's way beyond the 2% Fed rate. So now where do we invest? Stock market isn't a place to go, right? If I have cash in the bank, what should I do with that money so that we preserve that cash? Don't lose it. Now that is a good question. So what are our options? Leave it in the bank? Well, that's probably one of the worst places you can go because inflation is killing it. If you have $1 million in the bank and inflation is 8%, that means at the end of 1 year, 12-month period, you now only have $920,000 of spending power in the bank. Right. So inflation is eroding cash savers, eroding fixed equities. Yet that's definitely not the place to go. Then what's the next place you look at? Stock market. Well, stock market, especially places like the NASDAQ, which is tech heavy, is also, based on future valuations and future valuation. The stock market it exploded because it was fueled by cheap debt. Well, that party's over now, right? So that cheap money is what also drives the value of Facebook and all these tech companies.
Right.
Now, when interest rates are going up, future values are worth less and the prices come all the way down. So has this bottomed out yet? No, I don't think so. Inflation crushes the stock market, and I don't think the stock market is going anywhere for another 10 years. So I definitely don't want to put my money there. I definitely don't want to hold it in anything in equities, right? So I don't want cash. I don't want equities. So then where do we go, right? Cryptocurrency? Maybe not. The train left the building. We lost $1 trillion of value. But then yesterday or day before yesterday, we saw the bank crash. Silicon Valley Bank, Signature Bank folded. And then we saw a rally to crypto. So people are like, well, banks isn't a safe place to keep our cash now. So let's move it over to crypto again. It's maddening, right? Nobody knows. Okay, so I wouldn't go to crypto either, right?
Go screw crypto.
What causes crypto to go up and down?
Oh my God.
Nobody knows.
Nobody knows.
Speculation.
Yeah.
Right. So I wouldn't go there either. So where should we go then? Okay, well, what about gold? Gold is a good hedge against inflation, right? In 1910, 1 ounce of gold, you could buy a really nice suit. Today, 1 ounce of gold, which is about $1,800, you can still buy a really nice suit. So amazingly, that's a good hedge against inflation, right? So, okay, so maybe there's a finite amount of it. You can't print more of it like we print money. So gold might be a good hedge, but wait, gold has no cash flows. Gold has no tax advantages. So, all right, so that goes out the window. Single family homes, we're going to see prices come down. They were at sky high levels. Interest rates are up. Single family homes isn't a way to go. So what do we invest in then? Well, you need to invest in something that can perform during bad times, like now, right? It should be able to produce income. Can it survive during bad times? It needs to be recession resilient. Number 2, it needs to be a hedge against inflation, it needs to protect us against inflation. We already know the stock market, cryptocurrency, everything is destroyed by inflation, but there are certain things that are historically great at hedging against inflation, and multifamily real estate is a perfect hedge against inflation. So, all right, so now we need something that can perform in a recession, can be a hedge against inflation, can give us tax advantages. Multifamily real estate can do cash flows heavily tax advantaged, all kinds of tax advantages that we won't get with gold. And we should invest in real tangible assets, right? Not in stock market, not crypto. That doesn't even exist. It's paper. Real estate, physical, tangible asset. It doesn't go anywhere. It's still worth something. So even if the dollar's worth nothing, the value of that real estate is still valuable. So people will still need to live there, and they're going to give you whatever's worth, whatever's trading of value of exchange, whether it's cryptocurrency, maybe people pay their rent in Bitcoin in the future. It's possible. But guess what? Whatever is trading for value, as whoever owns that real estate can collect it from the people that need to live there. Human shelter, the need for that doesn't go anywhere. So when I'm considering all of those factors, multifamily real estate checks all those boxes. You know, how does it hedge against inflation? Well, guess what? When the price of everything is going up, the cost of construction materials for us to do renovations and fix stuff, when the cost of human labor, wages are going up, there's a labor scarcity that puts upward pressure, inflationary pressures. When we have that type of environment where the costs of running real estate goes up, well, guess what? Every 12 months, we can adjust the rents, right? The lease comes due. Well, now the lease has to go up to this amount because the cost of everything has gone up. So we have to raise the rents. And what happens is raising rents raises market values, and rising rents and rising market values is what makes real estate investors rich.
Okay. Well, let me butt in here for a second, play devil's advocate.
Okay, I was saying what anyone would say here. You know, interest rates are rising. Okay, rent is expected to stop growing or even shrink in some markets, lower in some markets. So as the cost of my debt increases, and my rents pause or freeze or shrink, then where does that leave us multifamily owners, and how do we avoid that mess?
Yeah, I mean, that's a great question. And I think that's some major headwinds that a lot of operators are facing right now. And, you know, to say that the only thing that's really changed is the debt, right? The demand for housing hasn't gone away. There's still a scarcity of housing, right? There's still, we've decreased the amount of new construction that's gone up, right? The volume of new construction has greatly decreased.
Okay.
So the scarcity is never going to go away. Now, if you're located in a market where it's also continuously growing, if you're in a stagnant market or rents are decreasing, then I would say that the only way to really hedge against that is getting the debt piece right.
Right.
You know, having some type of long-term where you have extensions, but even that is getting more difficult, you know, as especially if you underwrite at 3%, you know, 2 years ago, and now all of a sudden interest rates are 7%, and you have rate caps, and you have debt equity requirements, that's going to cause pain and distress for some operators. I agree. And some of those operators are going to have to sell. Some will. And the good operators that can stay 95% occupied, that know how to squeeze dollars out of property, how to become efficient in survival mode. Yeah. I think we're going to see great operators get separated from good operators and even below average operators. Sure. So I think we're going to see some distress, and the way that distress is handled is going to be operator dependent. So, you know, I think execution risk is a big thing to pay attention to, even in this market. So, you know, answer your question, getting the debt piece right and getting with a good operator, coupled with hopefully in emerging markets where rents are continuing to grow, for some way. As long as you have a disequilibrium between supply of units and demand for units, you're going to see rent increases despite downturns or recessions. And there's precedent to that.
Yeah.
You know?
Let me add a couple things here as well. And good answer, by the way, as I play devil's advocate here. But what I like right now is assumable debt, right? You're seeing a little bit more of that come out of the woodwork. When I see the word assumable debt on the top of an email from a broker, I open it now, because that is a great play right now. So assumable debt, for our listeners that don't know, is when the seller of a property is selling their property, and the bank of that current property that has a current lien against the title is saying, hey, you know what, we're okay. We're going to underwrite whoever is buying this property, and if we like them, we'll let them assume this current mortgage on the property. Sometimes there's a small fee to assume the debt, but for the most part, it's a lot less than getting a new mortgage. Also, assuming debt from 3-4 years ago, 5 years ago, generally the assumption period is a period of time you could do it in. But most debt, if it was underwritten anything more than a year ago, is generally sub 4%. Like you're talking like threes for the. I think I'm looking at a property right now in Jersey City. The debt's like 4.3%.
Wow.
So right there, I could jump into a building with debt at 4.3%, and it's
You're positively levered,
right?
Which means you're good. All you have to do is just hold on, right?
Mm-hmm. Well, yeah, and increase rents as well. There is some forced value added.
Yeah, sure.
So that's rule number one. So assumable debt for our active investors out there, our active operators, and our passive investors as well. Look for deals that have assumable debt at low interest rates. That's a great way to invest in this market right now. Secondly, forced value add, right? That means you can really control what you could do with the building. I need to renovate the building. I need to renegotiate current leases. I need to improve the common area. I need to find more ways to make income, maybe through storage in the basement or parking or laundry. But most importantly, the building we just bought, the units are outdated, right? And we know we can physically renovate the unit. We have about $630,000 allocated for physical renovations to the units themselves. And that's called forced value add. There's a lot of different names for it. We like to call it forced value add. So that's something we can control. I'm not just kind of putting a unit on the market and hoping it goes for more money. No, I'm taking a unit that was rented for $1,350 a month because it's outdated and just undesirable, putting $22,000 into it, and they're renting it for $1,950 a month. And now we have a really nice renovated unit with all the whistles and bells. The rent rolls increased, the value of the building is increased, the way it looks, the appeal of it is also increased. The quality tenant we're going to attract with that unit is better as well. So we're forcing the value up on the building. We're really controlling that one little micro ecosystem right there, right? Our building, this unit, those are things we can control, in the marketplace. And that's what we're doing really well, renovating quickly, effectively, but also creating a nice, beautiful unit that's going to rent for top dollars. So that's called forced value add. And that's the only way we buy real estate here. I know, Jonny, that's your focus as well, is value add real estate. So that's the most important thing. You got to be buying stuff right now that has value add, rents below market value, more ways to make income on the property, possibly ways to lower your operating costs as well, right? All these things add to your bottom line, increase your net operating income, which is going to increase your property value. And whether rents are going up or rents are going down, interest rates are going up, interest rates are going down, you're controlling that environment. You're renovating units as they become vacant. You're leasing them up for top dollar. That's what we do here at PCG. And we control the value of our building by doing that. So by the time we're done doing this, it takes about 3 to 5 years to renovate the current building we're doing. By the time those 3 years go by, we're going to be looking at ideally a different market, a better market, and ripe for refinance at that point. So that's our goal.
Yeah.
And then one more thing also, interest-only payments, I like a lot as well. The building we just bought has interest-only payments. Now that can lower your debt service cost when you're getting into a project. Now, I don't suggest this for, again, a building with not a lot of meat on the bone, as they say. You want to have a lot of value add, right? A lot of ways to increase the value of your building by increasing the rent roll in the building, as I just explained. And as long as you have that ability to do that aggressively, increase the value of your building quickly and aggressively, then interest-only payments can be a great strategy. So we have 3 years interest-only payments. The first 3 years are the hardest. We're moving tenants out. We're renovating units. We're leasing them up. We're not going to pick the first tenant that puts an application in. So it takes time. We got to renovate them. We also have to work out an amicable exit of existing tenants. That takes time as well. There's some maneuvering to that. And so all these things take about 3 years to really reposition a property, take it from a non-performing asset to a desirable performing asset with renovated units and good tenants and a strong rent roll. So as we're doing all this, yeah, the market's going to have some turmoil, sure. But I believe in about 3 years, we'll be looking at a much better market, or at least just a more certain market. And
hopefully,
I mean, if we're not, then I don't know what to tell you. That's just, you got to roll with the punches,
Yep. Yeah, I agree.
Absolutely.
No, I mean, the value add strategy is also a great way to mitigate the risk of a recession or what's going on at the national market, because real estate really is a local market, right? It's a local market, and it's an inefficient market. So it moves very slowly. Right. I always say that real estate, with things happen in trends in real estate, like trend is your friend, they say, and real estate moves very much like, it's not like a speedboat. You can't move in and out of positions like the stock market. You're very liquid. You can buy, you can sell, you can move in and out very quick. And with real estate, it's more like a barge. It moves slowly. And so if you follow these trends, and real estate really does leave clues, like these cycles happen over periods of months and years. So it's just a matter of really paying attention. I mean, if you pay attention that, where people are migrating to, where are people moving? I mean, just going where people are moving already puts you in a favorable position, because if people are moving and looking for places to live where there isn't enough places to live, this is basic intuition. And that's how real estate works. It's not super complicated, especially the type of strategy that Aaron's talking about. It's block and tackling. It's simply renovating units and getting a high quality tenant, higher rent paying tenant to pay what everybody else is paying in that market. And as long as you go in and put your head down and just renovate the units, keep raising rents, renovate the units, slowly keep raising rents. It doesn't matter what's happening at the economy at large. It doesn't matter at all. As long as you're executing and you're getting people to come and rent those units from you and pay you rent, you can survive, and you get the debt piece right. Aaron talked about some great tactics to use: assumable debts, interest-only debts, keeping your debt service and debt obligation low while you renovate units. You can survive. And not only, we're in an investor winter, they call it, right? Like, ooh, it's cold right now, brr, yeah. But are we at the beginning of it? Are we in the middle? Are we at the end of that investor winter? That's what nobody really knows. Right. Just make sure that you invest in things that you can survive during the investor, because if you survive during the investor, then during the winter, when interest rates come down, cap rates go up, things explode. Yeah. And if you're able to survive during this winter time, that's how you thrive in the spring. Because in the spring, the guys that got it right, the guys that didn't shy away, because in recessions, in depressions, there's always transfers of wealth. A lot of people will lose money, but a few people will make a lot of money. Right. It happens every time. Guys like Elon Musk, people are like, oh, Elon Musk, he buys stuff undervalued. He makes most of his money during winter, investor winter times, right? When things are down. People are like, oh, Warren Buffett is so dumb. 90s .com bubble. Yeah. Oh, everybody's making money with .com, with all these .coms, and I'm buying this .com and that .com, and the values were sky high. And Warren's he's a dinosaur. He doesn't understand. It's a new changing times and this and that. And he was like, this doesn't pencil. How are you getting these valuations? It doesn't cash flow. Right. And he didn't buy anything. And then, of course, it crashed, burned. And then what happened? He went and bought a bunch of businesses undervalued. They were undervalued. Why? It wasn't because the business was actually doing worse. No, it was because of fear. Yeah. People are afraid. So when there's fear in the market, people stop investing, people stop buying, people stop selling. In fact, they sell everything and they get closer and get tighter. And that's what happens every time. But then there's savvy people, like even now in real estate, multifamily, there's a lot of buyers that have disappeared that were there just a year ago. Yes, we're going to wait back. We don't want to, interest rates are still going up. We don't know what's happening. Inflation, this, that. Sellers, also, they're not selling their real estate because, I used to be able to get X evaluation in February 2022. And now you're telling me that my property is worth $3 million less and my income has gone up. How is that? So those type of sellers that can't get over that psychological component, that value is actually based on debt. The debt going up is actually a leading indicator that prices are going to come down. So, but now what happens is buyers are gone, sellers are gone. Lenders have also got scared. There's fear in the lending market. Now we have less lending. Bridge loans disappeared for a while. Now we're slowly starting to come back a little bit. But why and lenders change their equity requirements? You know, before we used to get 25, 30% down. Now it's 50 to 60% equity required, higher interest rates. But why? The fundamentals of real estate hasn't changed. In multifamily, it hasn't changed. There's still there's still a housing shortage. There's still not enough housing units. You know, the demand for housing hasn't gone away. So why are the values of real estate down? It's because of fear. But we can buy, savvy investors, we have the ability to go and buy temporarily undervalued real estate, great real estate that's out there right now. And there's going to be the sellers that can afford to wait. Hey, look, I don't like these prices. I'm going to wait.
Right.
Fine, wait. But there's going to be people with distress, right? The 3 Ds, death, divorce, and dissolution. Those 3 things will lead to people having to sell. And when people need to sell and there's nobody there to buy, that's when guys like us come in. Yeah, well, we can buy it for this. There's some meat on the bones, but there's this problem. There's XYZ problem. There's this and this. We can afford to pay you X based on the interest rate. We buy it at X. Things change and we survive. We cash flow, tax free. We cash flow. We make money every month. And then the market changes, right? Cap rates come down, interest rates come down, people start spending, and the government starts printing more money, and it's a big party again. It's a big liquidity orgy. Then what happens? Asset prices come back up again. We're buying at expanded cap rates, and we're selling it at compressed cap rates.
Right.
It's a genius formula. So
it is.
Now is not the time to get shy. Now is the time to get educated and look for appropriate deals that do all the things that we're talking about. It's not rocket science. This has been done over and over and over again for generations. This is tried and true. You know, if you look in the 1970s, we had the worst recession in 50 years, right? 1981, Paul Volcker raised the interest rates to 18% to try to curb inflation.
There you go.
Stock market crashed. Multifamily real estate kept on going. Right? 1990s dot-com bubble, same thing. Stock market crashed. Multifamily real estate kept chugging along. 2008, great financial recession. Stock market crashed. Housing market crashed. Everybody was in foreclosure. Everybody had short sale of their house. Everybody was losing their homes. But where did those people go and live? They didn't go and live on the street. They went and lived where they could afford. They went to affordable housing. They went to multifamily real estate. 2008, housing market, stock market down, multifamily real estate up. 2020, COVID. We had a crash. Everybody stopped spending money. We had a global shutdown. People stopped spending on everything. Restaurant, hotel, leisure, everything. But they kept paying rent. Aaron, did you collect 90% plus rent during a pandemic? My guess is that
absolutely, my friend. Yeah, I think our worst month was like 86% collections, but
and this is during a global pandemic.
Yeah, we bumped
people are paying their rent.
Mid-90s,
So there's precedent for this. There's precedent for this. So we're not just sitting here making things up at all. This has been what's happening every recession. So there's, follow history. History just continues to repeat itself.
Well, it's funny, when I was graduating college in 2009, I remember, you sit down with your college advisor. They're supposed to advise you on your career path, and he said, well, don't go into real estate because real estate's down right now. It's the worst time to start a business in real estate because real estate's down. And I remember thinking to myself, even as just a senior in college, wait a minute, isn't the best time to buy is when prices are down? And isn't the best time to actually start a business? As an entrepreneur major, I just had learned the best time to start a business is actually in a recession. It's just, I look back at that time, then I got started in real estate. And I remember so many people saying how crazy you are to get started in real estate in 2010 when prices are down. Now, sure, it took me 6 months to sell a single house as a realtor. It was a very, very hard time to get started. But I got to say, it really separated the realtors who could move deals from those who couldn't. I learned short sales. I learned foreclosure properties. I met investors making millions in a recession and learned from their mistakes. And it eventually, over time, converted a lot of those active investors to invest in me and with me in apartment buildings. That was some of the first capital I raised. And but just it was such a great experience. And then again in 2020 with the pandemic, we all panicked, me included. I was a business owner there at my kitchen table thinking, what the hell is going on? What the hell am I going to do? I've never seen this happen before. I don't know what we're doing here, and where it's going. Should I be buying more? Should I be running for the hills and covering the hatches, So, but what I should have been doing is buying more real estate, and that in March, April time when everything froze and you could snag a great deal. They did exist. There was a small window. By the time June came, prices were skyrocketing again. But, we did actually buy some real estate. Then it was a great time to buy. But, you're exactly right. As Warren Buffett says, when others are scared, be greedy. When others are greedy, be scared. And we've seen both. We've seen a lot of greed in the last couple of years. We've seen a lot of greed in the last 10 years. We've also seen this, kind of everyone's a bit of a sheep. We all kind of follow what the other person's doing. There's so we're all getting the same news in one way or another. Yeah, you might get it with a blue logo behind it or a red logo. It doesn't really matter. It's all kind of there to scare you. And if you could read through the BS, you could be a savvy investor, but also be a realist. Markets do go up, markets do go down. So multifamily real estate is a great hedge. And I just wish my college advisor didn't say to me, put all your money in the stock market. Literally, as an entrepreneur major, hey, put 10% of your income into a mutual fund. Don't, you're not smart enough to figure out how to invest your own capital. Just put it into a mutual fund. And in time, when you're 59 and a half, now I'm 18, he's telling me this. I'm in college, so I'm 22. He's telling me a 22-year-old, when you're 59 and a half, you'll be able to retire. I just went through a 4-year degree in entrepreneurship. I'm learning about Elon Musk. I'm learning about people that didn't wait till they were 59 and a half to be able to be financially secure, and it was a really stupid goal to have, what a way, set the bar just as low as possible,
The accumulation theory. It's accumulation theory. Those financial advisors, all they teach is accumulation. Yeah. Try to accumulate and then depletion, accumulation and depletion. What a poor strategy. What a poor strategy.
I don't know why I was taking financial advice from a guy who
makes less money than you.
Yeah. I didn't.
This is what I tell most of the dental colleagues, that never take financial advice from somebody that has less money than you.
Right.
Never take financial advice from somebody who is not even investing in the things that they're telling you to invest in. Like the financial advisor or 401k plan. Well, the only people that get rich in 401k plans are 401k plan managers. And that's it. They take stock market's down right now. People's portfolios are down 35% right now on average. Now, did you know that they're still taking fees? These managers of 401k plans still have the nerve to lose you 40% and still say, well, you know what, you still got to pay us a fee for handling your services. So they want to get paid for non-performance. So now if they're getting paid whether they make money or not, where's the alignment of interest? And that's the most dangerous part. You're taking advice from somebody who's incentivized to sell you something.
Yeah. And I don't want to, listen, there are very good wealth advisors out there. And I do actually suggest everyone, have some type of wealth advisor. Now, a lot of people look at Jonny and I as wealth advisors. Now, we're not licensed wealth advisors, full disclosure here. And by the way, my friends, if you have questions, put them in the Q&A or the chat. We're going to open up for questions in just a couple minutes here. So be sure to put those questions in the Q&A in the chat. I see more people have jumped on as we go along here. Great to see. But yeah, absolutely. It is important to diversify. It is important to have some capital in, possibly, CDs are like 4 or 5%. You might want to snag one of those. The problem with that is it's a 12-month CD and you're kind of, SOL at the end of the 12-month period, right? With real estate investments, we never kick you out of our fund. You can invest with us indefinitely, keep building legacy wealth to hand down to your heirs 30, 40, 50, 60 years from now. When you're not around anymore, you can hand that down to your heirs. And that's, brick and mortar wealth right there, backed by solid real estate. So, it's harder to do that often with something that fluctuates so much like the stock market. And we're really mistaught at the end of college. I was mistaught wealth management. And you don't really learn wealth management in school.
Nobody teaches you. You just kind of figure it out on your own. And however which way you go, and whichever way is how for most of us dentists, we get no training. We just finish our program. We get thrown into the dental world. We start making money, and then that's it. We're just food for the sharks.
Yeah.
And that's why I'm on a mission to stop all of that.
Yeah,
there's no reason for this. I mean, the type of incomes that doctors make and the failure to make that jump from high net income to high net worth is very prevalent, especially among dentists, more than any other profession. I mean, this is what Robert Kiyosaki said. Dentists are most likely to be high income earners and be least likely to be financially free. And there's a reason for that. It's because we're not taught anything about what to do with our money. We're essentially, maybe there are some good financial advisors, Aaron. I have yet to find someone tell me that they had a financial advisor that told them to invest in real estate, that told them to invest outside of public markets. I have not yet found one. So maybe if you know someone, maybe they're cut from a different cloth. But if someone is telling me to go to equities, then that's not the guy for me.
Yeah. I agree 100%. I mean, for the most part, financial advisors can only sell you their products. They're actually not going to just offer you everything and anything. I've had people go to their financial advisor, say, I want to self-direct my IRA into real estate. And they'll say, oh, you can't do that. That's illegal.
Exactly.
You can't touch your IRA. No, I'm going to self-direct my IRA. I'm going to work with an IRA custodian, a third party that allows me to self-direct my IRA. And yes, I can put it into real estate. I can't buy a vacation home and go there with my family every summer for free, but I can invest in one of Jonny's deals or one of Aaron's deals, and I can make passive cash flow and get tax benefits and large lump sums upon the refinance or sales and build legacy wealth for my family with my IRA and diversify some of it out of the casino known as the stock market. So financial advisors can only sell you their products. Yeah. At least Jonny and I, we're honest about, hey, listen, at the end of the day, we do real estate investments. We buy apartment buildings in high demand markets. We help people invest in those buildings. And we suggest that, yes, in my company, we suggest you should have a 33 to 50% of your wealth diversified into high demand real estate syndications. It doesn't have to be People's Capital Group. You can shop around, try out a few different real estate syndications.
Aaron, I would say that 80%.
Wow.
In my opinion, 80% of your invested income, I follow the 80-20 rule, Pareto's principle, and I want to invest in only things that produce cash flow and have low risk. So 80% of all invested capital should be in low risk cash flowing assets. That means that you're not likely to lose your money, and it's going to produce you cash flow in a tax advantage way. 80%. 20% you can do speculative stuff. You want to go invest in a crypto mining farm. You want to go buy some digital real estate or, those type of things. Do that. There can be a place in your portfolio for more speculative investing. But if you want to really build wealth in a programmatic way, and you want to build wealth in a prudent way, in a tried and true trusted way, go real estate. Real estate has produced more millionaires than any other business out there. And this country has more millionaires than any other country in the world. So if we have a predictable path to get there, why reinvent the wheel?
Right. And
we have the capital to invest. That's the biggest thing that holds people back from investing in real estate is the lack of capital. But if we're busy professionals that we have this excellent job that allows us to be rich, then convert that to wealth and invest heavy. Get out of the stock market. Unless it's serving you right. If it's not serving you, if you're not getting cash flow, if you're not getting tax advantages, if you're not getting diversification, if you have no leverage, if you have no tangible assets, then what are you doing here? That's what I'm saying. 80%. That's my take. I have 0% in the stock market, Aaron. And some people think I'm nuts.
Yeah, absolutely. I'd say
I don't think so. I'm heavy in multifamily, and I'm invested across thousands of apartment units across the United States that are giving me little bits of cash flow everywhere, coming from everywhere. Where is my position have risk compared to the stock market, compared to anything else? Where do I have my risk? Please, I would love to, so that if I know that, And I know that this is where the super wealthy family offices invest their money.
Sure.
They all have big holdings in multifamily real estate. Alex Rodriguez, who has $700 million worth of multifamily real estate, said 50% of NFL owners who are all a billionaire boys club also have huge holdings in multifamily real estate.
Yeah.
If you want to be wealthy, you do what the wealthy people do.
Right. Just
They don't do it. I guarantee you wealthy people don't have 401k plans. I promise you. They don't have SEP IRAs and stuff like that.
But that can work. IRAs, 401ks can work for people that are, more working their way up the corporate ladder, trying to put money away, whether you're a dentist or just a busy professional. Self-directing your IRA or self-directing your 401k through your IRA is a tried and true way to build wealth. So
I'm not saying not to do retirement plans.
Right.
Because if you can not pay taxes, you should do it. But don't go into the conventional ones that they put you into. Don't put your head in the sand. SEP IRAs and 401k plans in it. I had a SEP IRA. I used to max out every year, Aaron. I had a 401k plan. Yeah. But now I've rolled over into a different type of retirement vehicle. It's a little different from SDIRA. It's called an EQRP. It's a qualified retirement plan. And I'm the custodian. I can invest in stock market if I so choose with my retirement fund. But I can also invest in deals like this, multifamily real estate. I can buy gold, physical gold. I can invest in cryptocurrency. I can invest in flipping houses. I can invest in raw land. I can invest in other things with my own money. Nobody's telling me you can't invest in that. You can only invest in the stock market. Right. So there are better vehicles out there, but your financial advisor will never tell you about it.
Well, they don't get paid. They don't get paid. If you move your assets from...
They don't even know about these sometimes, Aaron. They're not even taught these.
Yeah, it's like, it's imagine you own a Honda, right? You call and Johnny's like, hey, listen, you should drive this BMW. You call up your Honda dealership. You're like, hey, should I bring my Honda back and go buy a BMW? The Honda dealership's going to tell you no. Of course, they're trying to sell you a Honda. Johnny's got a BMW. So at the end of the day, financial advisors can only sell you their products, and they also get paid based on their assets under management. So it's in their best interest. They're not bad people. They're just running a business. They're trying to make
their job.
Their
job is to sell you shit.
Their job is to sell you their products, right? And keep your assets under them. And that's fine. It's not a bad thing. You should have some wealth in stock market, I suppose. I have about 1% of my wealth in the stock market. I'm very zero in real estate.
So if you're supposed to, I'm failure there, Aaron. I'm a little bit different. I got 0% in the stock market.
0%. I mean, I don't know. I just have a small IRA. I don't even look at it. I'm guilty. I'm one of those guys. My wealth is in real estate. I've built millions of dollars of wealth for myself in real estate over the last decade. It's a tried and true method, and 60% of the world's billionaires hold their wealth in real estate. But also, I remember when I was a realtor and I was making good money and I was investing in the stock market and I wasn't following those things I learned in Rich Dad, Poor Dad, I got nailed on taxes and I didn't have the money to pay it. And I had to go work 3 months of the year to go pay last year's taxes. And I said, never again. Last year, I actually got money back from the government and I still pay myself far more than I was making as a realtor. So now my tax strategy has completely been turned on its head. I keep more of my money. I pay myself through the refinance of assets, which is a tax-free payment strategy. I'm no longer a realtor. I learned the business that way. I made good money there, and there's no harm in that. But at the same time, I've learned how to pay myself through a tax-free strategy. And once you crack that code, it's like you never go back. Once you start seeing, planting seeds, a building here, a building there, I'm refinancing a building I bought 8 years ago, for the second time now. It's just, that money's going to be in my account, and it's just so nice to have those little seeds planted from years ago, those trees now that harvesting cash flow, liquidity payouts, high liquidity payouts in the refinance. That's what we do this all for. That's the magical feeling we work so hard to get here, my friend. We only got 2 minutes left. Why don't we answer some questions here? Here's one for you, Johnny. My question is it a good time to start investing in multifamily building now or wait longer as a dentist?
Yeah, sure. Let's see. Saif, this is Dr. Saif Hanna. I believe you're from Facebook group. Thank you so much for the question. The question is, when is a good time to start investing in multifamily real estate? The question is, when is not? A better question is, when is not a good time to start investing in multifamily real estate? No matter what, there's always a good time to buy real estate if you're buying it at the right price under the right terms. Always. There's always sellers that need to sell. And if you are a savvy buyer, you can buy. I believe that there is going to be a lot of distress in the market over the next 12 to 18 months, especially with a lot of floating rate debt that is going to mature over the next 12 to 18 months. I heard the guys from Walker and Dunlop say there's 30 to $50 billion of floating rate debt that's maturing next year, and that these guys had 3.3% interest rates, and now they're going to jump to 6.5% or 7%. And rate cap prices have gone way up, sometimes 10x of what it was just a few months ago. So those things are going to create opportunities. We think that there's going to be a lot of opportunities coming up in the market, and opportunities to buy temporarily undervalued real estate, like we talked about earlier. I think so. The answer is yes. Get into a great deal that is going to provide you cash flow and is with a great operator with lots of track record. If you get those two things right, and you get the cash flow, you get the tax advantages, and you can survive during these uncertain times, you can come up way ahead. So, I hope that answered your questions, Saif.
Mm-hmm. I love the answer, Jonny. And also, I'd like to just stress how localized real estate is. Is it a good time to get in real estate? Well, the answer to that question is which market, what deal? Bring me a deal in Bayonne, New Jersey, which allows you to commute to Manhattan in 20 minutes with rents 35% below market value and different ways to make income on the property and improve the management of it. Would you buy that deal? Yes, I buy that deal because I just did. That was a good deal. High demand location, tons of value add, right? So would I buy the other deal I got in my inbox later in the day? No, I wouldn't, right? That was a bad deal, right? So it's all about the deal. It's about the specific market. Maybe I'll buy Bayonne, but I'm not too crazy about Hoboken because it's got way too much landlord and landlord controls, there. It's just not a landlord friendly city, where Bayonne, stone's throw away, is a good city to invest in, right? So again, very localized market. The problem with right now, the news media cycle, we get the national numbers of real estate and the interest rates, and where they're going, and it paints really different pictures. We also are commonly getting residential numbers, and we have to understand residential real estate and commercial real estate are apples and oranges. There's some correlation, but for the most part, they are apples and oranges. They're different markets. So what's going on in residential real estate doesn't necessarily indicate exactly what's going to happen in commercial real estate. Generally, residential real estate does tend to be a leading indicator somewhat of commercial real estate. But as Jonny gave a lot of examples in history, we've seen residential markets collapse and commercial markets stay somewhat strong, especially in apartment building space, in the housing space, right? Because when it becomes too expensive to buy a home, as we're seeing now, what do people do? We rent, right? We don't go sleep on a park bench. We don't go to the Marriott and rent a hotel for 4 years. No, you go and you rent an apartment, and you go to an apartment building, you rent an apartment. That's what everyone does. So as prices go up for housing and housing becomes less affordable, we'll see, I think, more demand and rent, or at least a stable amount of demand in specific markets and rent. So, it's all about getting into those deals, look for those deals, have your deal goggles on, right? Now is the time to have that dry powder ready to go. Be connecting with operators like Jonny and I that are out there looking at deals. We'll look at 400 deals to bring you one good deal, right? Hours and hours of time underwriting opportunities, 400 bad ones to bring you one good one, to bring our investors one good deal. It's crazy how hard it is to find a good deal. So when your operator brings you that, make sure you're ready to strike. So you have your dry powder, your cash ready to invest. And make sure you understand your strategy, why you're investing in this operator. Pick an operator you like, follow them, understand what they're doing, join their webinars, look at their offerings, but also put your chips on the table, invest, take action. Because I've seen so many people through the years not take action, and even Jonny, I'll pick on you for a second. Now, the first building I showed you, the first time I drove you around 3-4 years ago, that building, you were getting to know me and you were not yet familiar with us enough to invest. And that was a savvy move because that was the first time we were going out. I was showing your operations. You're getting to know us. Now, if Jonny went out on a limb and was a little more able to take a risk with us at that time, he would have made a 24% annualized return on his investment in that deal we did. Now, we did another deal a few years later, and that was going very, very well also. But just a great example of a missed opportunity there where other investors did very well. And of course, in the future, Jonny and I are set up to make millions. We already are on the building we're invested in. But Jonny, just to pick on you a little bit there, a great example of a missed opportunity. But also, do your due diligence, know your operators, get to know them. And that's exactly what you were doing at that time, of course.
Yep. Yeah. I mean, that's the way I invest. I may lose deals, but you can't lose money on the deals that you didn't take, but
yeah.
And the way I invest is I'm very prudent, the way I invest. And especially it's very important for me to know who I am. The who is more important than the what, so, okay, we talk about multifamily and real estate and buying and renovating units and all that. But guess what? If you don't have the team that can execute that plan, which it's great on paper. It sounds great on paper, but can you actually go and do it? Like manage those tenants, take problematic tenants out of units, through eviction court, through incentives, through rent, doors for keys, that whatever the strategy is, can you take non-paying, non-performing tenants and put a performing tenant in there and then manage that property and then make it profitable and then generate returns for investors as well as sell? That's the most important part. So for me, I needed to see Aaron, and he did the right things, in my due diligence. I do due diligence on the people that I partner with. And he drove me around to all the properties that they already owned and managed in New Jersey. He showed me several of them. He showed me, what they're doing. He showed me their head office. I met the key personnel in the team, the sponsorship team. His partner, Seth. I also know Seth very well for many years now also. So I became very familiar with the team, with their core values, made sure there's an alignment, and then making sure that there's a track record, relevant track record, not just, I was in real estate for 20 years. No, but I've been in multifamily real estate in Northern New Jersey, specializing in Class B value add. So when I hear that a specialist in a certain area that owns and manages their own units, that greatly lowers the execution risk. If we lower the execution risk, that's probably the most important part of a passive investment, because since you're extricating yourself from the day-to-day, which is what I want to do as a busy professional, right? I want to save on the 4 T's. I don't want to ever deal with tenants. I don't want to deal with toilets. I don't want to deal with termites. And I don't want to use my precious time.
Right.
So if I want to extricate myself from the day-to-day, then I want to make sure that the best of the best is the one that is doing it. They're going to do it better than I can do it.
Yeah.
I can do root canals better than anybody. Better than you, Aaron.
I bet you
I
could.
say there's another endodontist on here. I'm not as good as Dr. Sean Bullard, but I can do it better than most people on this call. And that's what I'm going to do.
Yeah.
I'm going to let people, I'm going to defer the expertise of doing the do in real estate to the experts. And that greatly increases my chances of getting returns and saves me my time.
Love it. Love it. Jonny, awesome stuff. So let's wrap up here for the evening. We did allocate an hour for our guests here, so I want to be respectful of everyone's time. Put your website there, my friend, or even a link for people to connect with you in the chat. Make sure you send it to everyone, by the way. You should be able to do that. If you can't, you can send it to me and I'll copy and paste it in. But to our listeners here, to our guests, thank you so much for joining Jonny and I here tonight. What we talked about was the investor winter that we're experiencing now, the recession we are in. We put on our hats here. We tried to look into our crystal balls and figure out where the market's going, but it really wasn't actually about that. It's about just being smart with investing right now, just an overall long-term investment strategy of diversification focused on real estate, especially multifamily housing. We touched on the impact interest rates and where rents are going is going to have on our investments here in our investor groups. But we also recognize that, this is a good shelter from the storm. And if it's managed properly, bought in the right markets with a value add strategy implemented over time, then yes, multifamily housing could be a great investment right now. and in the future. In fact, what we're seeing right now might even be the best time to get into real estate. If we can snag some good deals for a great price in the next 18 months, then you got to invest right now, because now's the best time to get those deals at discounted prices. So keep your eyes open for those deals. Start talking to operators that are making moves and presenting strong investment opportunities to you. Now, at People's Capital Group, we focus on the New Jersey market. We're a vertically integrated real estate investment firm with an in-house property management company. We also have a real estate group with about 10,000 people in it. We have a networking group event coming up on the third Tuesday of the month. That's Tuesday of next week, coming up at the Jersey Cyclone Brewery in Somerset. So if you want to check that out, go to peoplescapitalgroup.com. You can sign up for that event coming up at the Jersey Cyclone Brewery in Somerset, New Jersey. That's going to be Tuesday night at 6:30. We do that every single month. We also do these webinars almost every week as well. I have on all different types of guests. Not all as exciting as Jonny, though. So Jonny is one of our best guests. So definitely team up with Jonny. Now, Jonny, how can you help our listeners here?
Well, listen, I mean, if you're interested in learning about Walk of Wealth and what we do, we help people invest intelligently across multiple geographic locations, invest intelligently across multiple operators, as well as invest intelligently across multiple investment theses. So, you can check us out at our website. It's walkofwealth.com. I think I put it in the chat. I put the link there is to join our investor list. You can get join our, get our blogs. We have a vlog. We have all kinds of resources, downloadable resources, things that everything that's there is try to help is curated really for the busy professional, really the doctor, dentist, to learn about passive investing. Things like a due diligence checklist on a sponsor. For example, say, hey, I like Aaron Fragnito, I like People's Capital Group. I want to maybe potentially invest with them. Well, I created a checklist of some things that you should go through, some questions you should ask, so that you kind of have an idea what you're looking for when you evaluate a sponsor. We talked about how important that is in these deals. So definitely go on my website. It's a free download, the due diligence checklist. There's a bunch of other stuff. It's a great place to learn about passive investing. That book right here, Beating Dental Burnout, that's a book I wrote, ebook. That's a free download as well. It's a great way to get started. There's a bunch of resources there. If you want to learn more about investing alongside us, you can go join our investor club. The link is there. Just enter your name, your email, and some other, answer some questions. And we'll be more than happy to learn a little bit more about you.
Awesome. So guys, to our listeners out there, take advantage of everything Jonny and I are giving you. This is all free stuff. Our time is free. There's no charge for this webinar. We've done over 300 transactions combined, tens of millions of dollars, hundreds of millions of dollars of real estate accumulated through just the last decade on my end. And Jonny's been just accelerating through the industry here in the last few years. So take advantage of what we're offering you right here. Both our website, Jonny's walkofwealth.com, and my website, peoplescapitalgroup.com. I mean, I have over 130 podcast episodes. I have dozens of webinars up there. I have multiple ebooks. Jonny's got an ebook out. He's got tons of information on his site, so check that out. I know Jonny goes live, I think, every Tuesday night, right, Jonny, on your YouTube channel?
We paused that for a second. Please join, and thank you for saying that. We go live in our Facebook group. We have a brand new Facebook group. It's called Financial Freedom for Dentists. Definitely search that. It's we have a bunch of interviews and stuff. Actually, Aaron, we're gonna have to have you on there at some point as well. And that's going to be a place that you can interact with myself, with all kinds of other, dentists that are and savvy entrepreneurs, dental entrepreneurs, especially. I put the link for that there. Join that. It's a private Facebook group. Those are the two best ways. I mean, you join our investor club, you join our Facebook group. I have a YouTube channel as well. Yeah. I don't want to give you too many things to click on. But I have a lot, we have a lot of resources, a lot. We're coming out with a whole bunch of more stuff. It's really just to help all our dental colleagues to get the knowledge about passive investing so you can invest wisely and prudently and make returns a predictable thing, right? And building wealth programmatic. And you don't have, like I said, we don't have to reinvent the wheel. So the blueprint is there.
Okay. And Nancy asked to speak the name of Jonny's website. It's PassiveCashFlow.com. But it's important that you're learning, that you're engaging with us. Set up a call with Jonny, set up a call with me, learn about what we're doing, how we're doing it differently, what we're doing the same, how we're helping people build their wealth. There's not a right or wrong answer, like I said, in real estate investing. You can invest in New Jersey markets and focus on one space like we do here with our in-house property management company. You can invest throughout the nation with Jonny and multiple operators in multiple markets. So there's no right or wrong answer. The only right answer is that you're taking action, connecting with us, learning how we're helping people build wealth, and investing wisely alongside us. So any parting words from you, Jonny?
No, that's it. Thank you so much for having me, Aaron. I really appreciate the time here. I hope everybody gained a lot of value from it. Please reach out, give feedback, comments, questions, anything else you'd like to see in future videos, and maybe even any other resources that might like to see available that's not out there. And that's something that we would like to, we're just trying to bring lots of value. I mean, that's where our value proposition is education. I think education is the biggest key that opens doors, including it happened for you as dentists, and it's the same thing for you in investment.
Awesome. You know what, Jonny, I'm going to download your operator checklist and work myself through it as an operator. Make sure I
and see how good you fit in, right?
Exactly.
Check the boxes.
You got to be ready like that. I love it.
Yeah.
I love it, man. I'll put myself to the test. So good stuff.
You know what? People on this call, they're going to go download my investor checklist, and then they're going to book a call with you and ask you all of those questions. So go get that. Go download that guide there, Aaron.
Bring it on. Bring it on. Okay. As long as the question is like, what is your social security number?
Yeah. What is your social, by the way, Aaron?
What is your social? Okay. Let's. If someone calls you and asks you that, don't give the answer.
Don't give it to them. Don't give it to them.
It's a scam. Oh my gosh. All right. Thank you so much, Jonny. Thank you to our listeners. Great turnout tonight. To my friends, those links are in the chat. I'm going to click off. I'm going to end this webinar in 5, 4. Click that link in the chat. 3, 2. Okay. Have a good night.